Right. So before we dig that, I think you gotta
Yeah,
explain.
the
Well,
new model.
you already did it anyway. So that means you probably found ways to mitigate the risk we just talked about. So what is it? Like, what's your new model?
Okay, yeah. So this new model, actually, you just mentioned the two risk or that how to say like two shortcomings of this strategy. One is stock price fluctuation, especially with long-term holding. Another is, say you buy this flow through shares, say April 2024, and you're holding it for a year. You have 100 grand invest in it. You are not getting anything back until next year, May, after the tax season, right? So all the money are held there. So those are the two shortcomings. By introducing a third-party liquidity provider, we can mitigate both of those. So what happens is there are third-party companies, for example, big bank mutual funds, which are, by law, they're bound to hold a bunch of mining companies anyway. If we give them a discount as an investor, we give them a discount. Say public trading is $1, and when we sell them at 70 cents. Those companies are going to be really happy buying it from us. And we can negotiate. And this one, from $1 to 70 cents after our calculation, it makes perfect sense. We don't have any more stock price fluctuation risk. However, we are still making a lot of money. It didn't tank down to zero. We don't have to hold it. We can sell it on the same day. And some of those money, like 70% of the money you put down, will come back to your pocket right away or in a few days, just wiring back and forth. So
What?
only about 30% or 35% of the money is you put down initially would go all the way to the tax season. All the rest came back within a week or two.
That's too good to be true. So you're telling me that what you're saying is that you're telling me that you're able to buy the shares and offload it almost 70% of it right away within a few days. So you do not have to take any risk or take much risk on the stock fluctuation, but you are guaranteed to get the tax write-off.
Yes, that is correct.
Wow. Okay. So that's too good to be true. So this solved two problems at once, right? Like I do not have a liquidity problem because like I literally just put down the lump sum money and I can get it back in a few days. And then I also eliminated the price fluctuation risk because I'm not holding the stock. Somebody else holding my bag. How is that even possible? Why? Why
Well,
is that? Who, like, I mean,
yeah,
there
yeah.
can be stupid buyers, right? Like, why is there such a demand? Like, why?
Well, like I said, first of all, those, for example, those big banks, they have all kinds of mutual funds, and they need to hold mining mutual funds anyway, which is a pool of maybe 40, 50 companies in there. That's usually how they do things. And by them doing it, they usually don't do quick trading. They buy and hold anyway. They want to probably hold it forever, right? So, or at least for a few years. So they selling them that, or they hold this risky stuff. It's okay because they have other ones to say like mitigate the risk. They probably have like 50, 60 of them in their pool to mitigate the risk. Maybe one or two became really successful, like 10 became okay, and the other 40 didn't find anything, price tanked. But in the end, they can't just, I mean, as the bank mutual fund, they just can't get rid of the mining, altogether. So they got to hold something anyway instead of going to public and buying high price shares. That's why they want to buy the low
Okay.
price share from
So
us.
what you're telling me is that people who are like us, we don't care about this stuff. But people who are like big insurance company or big fund, like segregated funds, whatever, they have a mandate. I don't think it's by law, but I think it's by their theme, like either by their investing
Well,
theme, and it's by their mandate
yes,
that they need to hold certain number of, portfolio of mining companies in their portfolio. And I guess if they buy from you guys, they're getting at a discount compared to the public market. Is that right?
Yeah.
So it is
And
win-win. Okay. So they make money too. Okay. And
exactly. Yeah, you gotta give how to say like give a profit, share the profit to others.
right.
And this is a huge, if you're willing to take all the risk yourself, you can get probably like 50, 60 grand all by yourself. But if you're sharing it out, you might get like 20, 30, but you don't have any risk anymore. Oh,
Okay.
sorry, I shouldn't say any risk. You still might have a little bit of risk, which I'll tell
Which
later.
we're gonna
But
discuss.
yeah, there's
So
nothing that riskless.